given the level of market volatility and news, we thought it would be good to update you on what we see going on in the world and markets and economy, and also answer some of the questions that we think you're likely to have. As in the past, I'll kick this off with a really short introduction and then turn it over to Christians, where we'll take a deeper dive into some of the significant areas that we want to focus on, which will be what's going on with COVID-19 or the coronavirus, and what the impacts to the economy and markets are likely to be. So if we start off, a couple months ago, if we had a call with any one of our clients, we might have said that the economy, the global economies, the consumer, corporate balance sheets were in really good shape, and that things were kind of moving along with slow and steady growth. And enter the coronavirus, and the whole picture has changed. The virus has spread rapidly, and markets have responded with strong volatility. Stock prices have plummeted, and if you've noticed, bond yields have gone to historic lows, and that's because investors are seeking safe havens. And so interest rates are at all-time lows we haven't seen in our lifetime. Aside from the human concerns and fatalities, the biggest concerns from how we work with all of you is the damage to the global economies, and then the question about what is the risk that this leads to a recession. Unlike a normal recession, which kind of piles on and sort of a vicious cycle that feeds on itself, we're in a very different situation. This is a shock to the system. And depending on how quickly this gets resolved will help determine the severity of the shock to the economy. So a couple other things here. So the last time we've had a significant downturn was in the 2008 mortgage market collapse. And unlike then, while there was a great risk of recession and the news headlines were about possibly moving into a depression, the global financial markets today are very healthy. They weren't back then, and they are today, and they almost shut down back then. And also, it was in 2008. It was difficult to imagine how the world was going to avoid some type of collapse. Here, we're in a very different situation. We can avoid a global pandemic, and all it takes is some modern medical science and possibly some work on the part of governments to isolate the illness. The other good news is governments will provide significant monetary and fiscal stimulus in light of the crisis. As we noticed last week when the Fed Reserve dropped interest rates 50 basis points, and other central banks around the world are following suit. So what we expect going forward is that there will be lots of volatility over the next several weeks and perhaps months. If we look out longer term, there will be significant rebound in the markets. Going back to previous epidemics or pandemics, SARS, the worst period, the market had declined by 12.8%. 6 months later, it was up 27.8%. The avian flu back in 2004, the worst period saw the markets down 6.9%, but then they had recovered 12.6% 6 months later. MERS in 2012, the worst period, the markets were down 3.8%, but then within 6 months, the markets were up 22%. Ebola in 2013-14, the markets at their low were down 5.8%. Within 6 months, they were up 11.3%. Zika virus in 2015 and 16, the markets were down 12.9%. And 6 months later, they were up 19.5%. In all cases, once the health scare had begun to dissipate, where we saw a solution, the markets recovered. We expect the same to happen here. It's just not clear exactly how long it will take to have a solution to the health problem. But we do expect that some point within the next near term, meaning 6+ months or so, to see a significant rebound in the markets. So with that, I'll pass it on to Christian to maybe go into a little bit more detail about what you see.
Yeah, hi everybody. So I'll talk for about 5-10 minutes, hopefully tops. And if you have any questions, I think there should be a chat box up on the web to put your question and answers in. And if not, feel free to direct message me on the following number, and I'll give it out twice: 203-435-7903. Again, area code 203-435-7903. And just feel free to throw in questions as things go along. So, okay, just to start out here, this is certainly a day for one of the record books. Anyone who's gone through the early 80s, 87, the 90, 91 long-term capital markets, the 2001, 2002, and the various bouts of volatility we have since then, you know, this is right up there with them. This is a very weak day, and what we see now is the 10-year government yield at 0.5%. As Steve mentioned, that's a record low. Not in real terms, but in nominal terms, it certainly is. And I'll come back to that later. And we've also got the US yield curve all below 1%. So every single Treasury bill going out from overnight out to 30 years is now below 1%. Again, that's not happened before. The S&P is now down about 18% from its peak in early February, down 14% for the year. For the 12 months, it's still a positive number, only just. And the other markets year to date are sort of similar magnitude, in some cases greater. The European markets down about 17, US small cap down about 22, which you'd expect. Emerging markets down 9 and 9/11, and international down about 11. But they actually had a much weaker 2019, so they were coming up and falling down from a lower base. So what's caused all this? Well, let's get on to the broad reasons in a minute, but most immediately, we've just had the Fed cut. Now, they came out the Friday before last, and then again on the Monday, and then last Tuesday, seems like a year ago, but it was a week tomorrow, they cut the federal funds by 50 basis points. They very rarely, A, cut by 50 basis points, it's usually in 25 basis point increments, and two, do it outside of a meeting. The next meeting is scheduled for March the 18th. So this was very sort of not completely unprecedented, but very unusual move by the Fed. And I think that they're finding out that, one and done is very hard to do. The market didn't have the reaction that I'm sure the Fed governors hoped it would last Tuesday, which was to put a tank full of confidence into what was a sinking market. But it just shows how difficult it is to use monetary policy in these types of environments. And risk assets just don't respond, positively to, every dovish impulse by a central bank. I think what the market is saying is that, yes, we're glad that the central banks seem to be realizing that easing is a good thing. You don't want to leave it too late. You don't want to have a policy error, but it's probably not enough. There's going to have to be other entrants on the stage at some point to make this more bearable to the markets. And of course, the other entrants really are only on the fiscal side. As at the moment, the fiscal response from major economies, including the US, has been little to zero. So I think that's what the markets are waiting for. So why has all this happened? Well, obviously, front and center is the recession fears that the virus causes. And this is really what is broadly called a supply shock, but it's a kind of a grand way of saying, look, if people can't get to work or serve in restaurants or produce the things that they're meant to be doing in factories in the US or service economies elsewhere, then there's just going to be less things and services for people to buy. But those supply shocks, as we've known from the past, can very quickly run into demand shocks, where the same people who are out of work suddenly don't have as much available money to spend as they did. Discretionary spending goes down, confidence goes down, and pretty soon you're in a pretty big downward spiral. Now, we're not there yet, but the fears are very much that there'll be a shock to the economy and possibly moving into slight recession territory. And I'm talking globally here, not just the US. At the moment, really on the grand scale, we're talking about 4 countries: China, Italy, Korea, and Iran. Most of those, the China number of cases seems to be ameliorating quite a bit. It's about 10 people a day in a population of 1.3 billion. But Italy and Korea and Iran are definitely trending up. And then the news over the weekend that Italy has quarantined about 11 northern states, which is about a quarter of the population, about 2/3 of GDP, obviously has sent a lot of concerns throughout the market. What will happen in the US is it's really too early to say. We had great employment numbers on Monday, but that survey was taken 3 weeks ago, which in these fast-moving times is equivalent to ancient history. So no one's really looking at any of these economic numbers right now. They're not coming through in the ones that matter and that we all measure. But they will. Things will slow down for sure. We'll probably see it in things like consumer surveys next time around. It always showed up in the Beige Book last week, which is the corporate sector. I'm sure some consumer confidence will start to take a hit, and then it'll show up in things like retail sales. But the one area which we would be looking at is what happens in the claims market. That's every Thursday morning. That's been very solid. It's been about 220,000 claims, jobless claims every week. That's a very low number by historical standards, but that's where it'll start to show up if the corporate sector starts getting frightened. But I don't think it's going to show up yet, because typically the corporate sector, what it does in response to these types of shocks, and let's call it both a supply and a demand shock, is first of all stop hiring. And that won't show up in the claims numbers. Then it might move on to letting people go, but that's a bigger decision because you have to retrain people, rehire people, and you're not in a position to take advantage of any snapback in the economy if you start doing that. So I think what we're likely to see is a slight fallback in hiring numbers and hiring expectations, but nothing will show up in claims yet. The other thing that's going on is, and this is, I wrote about it in the blog, I think it's very important, is that unlike 2008, 2009, there's no massive leverage in the sector and an illiquidity event which could really stall things out and bring the economy to a grinding halt. The household sector is indebted, but it's much lower as a percentage of personal income than it was 5 years ago, 10 years ago. The household was very severely frightened by what happened in 2008. It's essentially been deleveraging ever since. And debt service costs as a percentage of personal income are incredibly low. It's the same for the corporate area generally. Corporate borrowing has been relatively high, but it's matched against quite high cash expectations. And companies still they don't like to do it, but they can cut their dividends. And of course, they can cut back on share buybacks, which are equivalent to about 4% of the S&P put together. But there isn't generally a lot of excess in the corporate sector, except in some high yield areas, particularly the Kraft Heinz of the world, the kind of companies which have just had massive execution area mistakes. And the energy sector. I mean, the US oil and shale and gas and energy sector is really only profitable about $55 to $65 a barrel. At today's price at 35, there'll be a lot of them who will either start defaulting on their bonds or will go into some sort of liquidation. So that's one area which is going to show up in the corporate sector. And the government sector is certainly not in as good shape, but I worry less about that just because the US borrowing capacity is very, very high. I know we get worried about the budget deficit numbers. There was some pretty reckless tax revenue cuts a year and a half ago, which have spiked up the deficit as a percentage of GDP, but it's still only the marketable side of it's only about 75% of GDP. I say only because there's a lot of other countries that can borrow way ahead of that and actually borrow at rates less than the US. So we don't want to see an explosion in US debt, but it's something that I think the markets can handle very, very, very well. So yes, one for the record books, as I said, I don't know how the next few days are going to be. We are seeing a lot of stocks go down. There isn't many places safe to hide. We've just seen a few things in stocks like Dollar General, Walmart. A few of the healthcare stocks have gone up, but these are really just stories which tend to do well if there's a big recession on the horizon. Talking about the recession, the US economy is actually quite good shape. I covered some of these points in the blog. I've covered some already, but the consumer is in relatively good shape. Business owners are in good shape. What's not so good on a global side is, Chinese manufacturing and services, which is still recovering from the trade talks / war stuff, whatever, you want to put behind them, but were pretty disastrous for world trade in 2019. And US manufacturing is only just recovering from that hit from the trade wars plus the Boeing problems. So that will at least postpone some of those things. And now we just kind of sit and wait. This is not a time to move to cash in big numbers. I think it is a good time to continue to put protection on the markets. And we've, as many of our clients know, we've had a very large proportion of our investments in treasuries, and we were there because you don't have a credit risk event. Corporate credit bond yields spreads have widened out, whereas treasuries are still the ultimate safety trade. And we've also had the floating rate notes, which have helped a lot. And we've also had a fair amount, a low amount in emerging markets and international, though those are going to start getting interesting again if they have another leg down. And of course, also what we've had is the various different structured notes. These are ways to protect the downside, cap the upside for sure, but they protect the downside in some of these equity market sell-offs, both here and overseas. And actually, most of those bonds that we've done have been better than being in the long position and have turned out to be quite positive.
Christian,
so there we are. So sorry, we're not taking a big scalpel to the portfolios. We think they're in fairly good shape. We still have a very good high quality bias in all of the equity and fixed income exposure. And I think we just kind of wait for this to run down over the next 2 or 3 days to kind of get the panic selling out of the way.
I think, Christian, one of the questions that I've heard from a few people is, what should we be doing now? And I think part of the message, though, nothing has been done. One of the things that Christian alluded to were some of the changes we've made in terms of adding treasuries, structured notes, buffered notes, reducing what we had in emerging market foreign, and also higher quality bond portfolio and equity portfolio. Those are things that we actually have been preparing over the last 2 years. So rather than there are many things changes we've made already in the portfolios to be in a position to have protection in a case like this. So it's not as though there are, as you mentioned, I think I'm not sure I like to take the huge scalpel to the portfolio.
We're not doing that.
No.
We're not doing that. There's not really much to do because we've already positioned the portfolios for this, but I think there are going to be some opportunities coming out the other end of this too, once we start to see some clarity of where the markets settle out.
Yeah, here's some question that came up on the web. That's great. I'm reading it real time, so it might be a question I can't answer. But with the confidence that the markets are going to rebound, isn't it a good time to buy some stocks that have been beaten down for no good reason? Yeah, possibly. I mean, there's the whole metaphor of catch a falling knife. It could go another 5 or 10%. The market's not gotten really cheap. It's gone down from about 18 times earnings to about 16 times today. And where it was really cheap was in December 2018, where it got down to about 14 times. And if it got down to that level, I'd have no hesitation in jumping straight in. But at the moment, we've got markets revaluing themselves from a pretty high multiple, 18, to a slightly less high one at 16. And we know that we're going to have flat earnings this year at best, and some parts of the stock market, energy is only 5% of the S&P, but it's a much bigger number of S&P earnings, more like 12%. They've taken a huge hit. So I don't think that there might be some tech stocks that are good, high quality, but I think for now, there's a reason that every stock went down. I think, unfortunately, there's very good reasons why these stocks are down. I don't think a lot of them are going to have big comebacks because they were pretty expensive to begin with.
Another question, though, that comes up, Christian, is if you have the difference of jumping in versus someone who has new money to invest in the markets, and what would be a strategy?
Oh, I think in no doubt that anybody putting money into the market should do it over the next 6 months in kind of equal installments. So if you bought on a day like today, we'll probably get a snapback tomorrow of 2 to 3%. That's kind of the way things work with short coverings and so on. It'll probably be good. It might be down another 5% a month from now. But the chances are that if you can stick to a 6-month dollar cost averaging, slowly getting into the market, I think that will look very good within about a year or two.
I agree. I think that makes a whole lot of sense.
We have another write-in question actually from one of our clients, and it says, what's the best advice for investors of our age, 73, 75, who don't have 20 to 30 years to recoup our losses? And I perfectly understand that question and sympathize with it. I think first of all, we've got to think about a very balanced portfolio for someone between 70 and 75 who's looking to live off that portfolio for probably another 20 years, where the equity exposure should be between about 40 to 50%, depending on personal needs, current needs, and so on, personal circumstances. And then the fixed income side should be the other half, where we will see the Treasury is obviously doing very well, but the yields kicking off that bond portfolio should be in the region of about 2 to 3%. I think that's where the best kind of recouping of losses should be. Also using the equity notes, because those are a very good way to participate in the upside and have some downside protection. You don't do as well as if the market really takes off, but I think as a brave person right now, I think that the market's going to return 30% over the next 12 months. I'd much rather see protection taken out in those types of notes.
Well, also bonds have buffered the portfolio to a great extent, because if stocks have gone down, bonds have gone up pretty dramatically. So in looking at client portfolios, they haven't really gone down,
no,
in a big way at all. So
That's right.
that question about I don't have 20 to 30 years to recover, portfolios have really been held relatively intact even during this damage, and that's just because they're the bonds primarily, but also the buffer notes.
That's right. Looking across client portfolios, with the S&P from peak to trough February 19th peak to now, it's down about 17%. Our more balanced portfolio is down only 7, 8, 9, well within recovery levels. Asset allocation, as we've said, should account for should do most of the heavy lifting.
Mm-hmm. And then also our normal policy in terms of managing the portfolio, as you know, we're not market timers. We don't sell everything and go right back in again, but we do have a discipline of rebalancing the portfolios, which is after market drops to take money out of the safe asset classes to move back into stocks at cheaper prices, and on run-ups to trim some of the appreciated assets of stocks and move them back into bonds. So that's a discipline of basically, you want to call it buy low, sell high, taking money off the table after big run-ups, putting money back to work, which we will look at with all client portfolios here as well. So if there are opportunities to put money to work in markets or specific areas of the stock market that makes sense, we'll be looking at that over the next several months.
I've kind of whipped through the slides really because I've talked around most of them, but I'm going to leave this one up at the end here. I don't know if we can slide off the question and answer one if that's
They're
fine.
not seeing that.
That's how that, okay, they can't see it. Okay. Well, this is interesting because we've now joined the global world of low rates. Over there on the right-hand side, I did this, I think this is from Friday when the 10-year was 0.91. It's almost half from that level now, 0.5%. Quite outstanding. But there we are. We're there with Japan and the UK and Switzerland, Germany, and probably about 20 other countries have rates lower than the US right now. So we're in this kind of very low rate world. Now, what does that mean? I mean, clearly the bond market is saying that a Fed cut is going to come, a recession is likely, demand for credit is going to decline, and the stocks are just kind of have to follow in that wake. The bond market is all about expectations on yield and rates, and the Fed has been fairly dovish. Now, how low could it go? Well, if you'd asked me a year ago, could the 10-year go below 1%? I'd say, well, that's a brave bet. I don't think it ever would. But now we've got the 30-year below 1% and the 10-year at 0.5%. So we are hitting, records as we speak. I think we're going to be in a low rate environment for quite a time. I don't think they're going to stick around at 0.5. That's the new 0.9 from the chart, for exceptionally long time, because the US does have a dynamism and an ability to grow and respond in a way that many of these other countries don't, particularly Japan and Germany. But it's going to take some coordination. It's coordination we're not seeing at the moment. We also talked this morning about the US and its vulnerability in a virus world. And my own feeling is that the US is a little bit more vulnerable just because we've got this healthcare system where 40 million people are either unemployed or uninsured or underinsured. And so how are they going to be able to cope with a test which might cost them thousands of dollars? We also have a lot of people in the service and gig economy, probably another 25 million who should be maybe staying at home but can't afford to. And we also don't have any sick pay leave mandated as most other countries do. So I don't know. It'll be interesting to see how the response to this, whether it's at state level or government level. But until I see sort of proof otherwise, I think the US could be pretty vulnerable to this, and perhaps more so than other countries. Okay.
So we don't see any other questions. So we want to just mention that we believe the portfolios are in, we're very comfortable with the portfolio despite the volatility, and we think the portfolios will do well in this environment. Christian will be writing his blog on a weekly basis, so if you'd like to see additional updates on our thinking, you can catch that at the end of the week, usually Fridays, when he publishes his blog, which will give updates on the economy, the coronavirus, and then how the markets are doing. In the meantime, we'll be watching the markets and the economy and the spread of the coronavirus very carefully. But again, as we said, we've already prepared the portfolio, so there's nothing we need to do at this point in terms of additional protections, because we're already there in our view. And now we'll be looking for opportunities, which for first question that we had, I think is not right on. We think it's too soon to jump in both feet because there'll be plenty of volatility. These things take a long time. I've been through this many, many times over decades, and these things never sort themselves out over short periods of time. They take months to kind of work their way through because market gyrations are all based on emotion, and it takes quite a while for people's emotions to kind of settle out.
So this call is recorded. We will post it on the blog, on the website. If you happen to be listening on this on a delayed basis and have a question, please contact us.
Yes, please. Either email any one of us, cthwaite@bnjadvisors.com, or text me at 203-435-7903, or just use our whatever contacts you have within the firm. We'll get it to the right person.
Okay, thanks very much,
Thank you.
everybody, for joining today.
Thank you.